Good morning, everyone, and welcome to this fabulous event that is brought to you by TimingResearch and TradeOutLoud. This is going to be 3 full days of options, Forex, and futures trading. And don't forget that this event is being recorded. So if you cannot be here for the duration of the whole event, you will be receiving the recordings, and you could also find them available on the TimingResearch website, along with other recordings from our previous events. So before we start, let me let you guys know that the information provided by everybody in here, including us, is for educational purpose only and should not be construed as investment advice regarding the purchase or sale of securities, options, futures, forex, or any instrument of any kind, because as you know, trading involves a high level of risk and is not suitable for all investors because you could lose money. So before deciding to trade, you should carefully consider your objectives, your risk appetite, and obviously individual results will vary depending on each person's skills, time commitment, and effort. And with us today, we have a fantastic lineup of pro options traders. And here is OptionsSamurai.com, Leav Graves, that is going to kickstart our event. Thank you so much, Leav, for accepting our invitation. You have the mic.
Thank you very much, everyone. Thank you, Anka. Thank you, David, for inviting me. It's a pleasure to be here. Good morning, everyone. I'm happy that you could join us live. And if you hear this recording, it's a pleasure. Really enjoy doing the last event, and it's a pleasure to kick off this event. So with that, let me start. So as Anka said, my name is Leav Graves. I'm a co-founder and CEO of Samurai, of Option Samurai. Option Samurai is an option platform that helps you find option trade opportunities in the market quickly and easily. Basically, we have a suite of tools like Scanner, TradeLog, implied volatility analysis, and more. And this helps you create and maintain an edge in the market. We're kind of like your superpower in the market. So this presentation is about option trading with overextended stock. The agenda is we will talk a little bit about what are overextended stocks. We'll see some example trades and back tests. Then we'll see a specific trade and learn how we can improve it with options. And in the end, we'll see Option Samurai, how we can find these trade opportunities. And we'll have some time at the end for questions if anyone has any. Again, before we start, quick disclaimer. This is for information, educational purposes. Even if we give specific tickers or outlook on the stock market, this is meant for education, not for trade. So it's more about how to fish versus like the fish, the specific fish. Trading involves risk, specifically options. So consider if it writes for you. And with that, let's begin. So if we start at a very high level, stocks can move up, sideways, or down, right? But they're not moving in a straight line. They kind of like zigzag. They are volatile. We call it like a mean reversion behavior. They are moving up, and when they're moved too much up, there's a higher chance that they will move down a bit and revert to the mean, and so on and so forth. So because we know that the behavior of stock is mean reverting and it moves in zigzag, how do we know when to kind of like when it's time for the stock to turn? So there are mean revision indicators. These are a family of technical indicators. There's a lot of technical indicators that are trying to do this, and they're helping us understand when the stock moved too much to one direction and they're supposed to move to the other direction. When the stock moved too much to one direction, we're saying that it's overextended. Specifically, if it moved down too much, we say that it's oversold. And if it moved up too much, we say that it's overbought. This is a chart from Stock Chart. And on the top pane, there's RSI. It has a normal range. And then you can see an overbought and oversold ranges. And in the main pane, Bollinger Band and distance from moving average are also mean reverting. And on the bottom end, at the bottom panes, we have a commodity channel index and stochastic indicator. Both are also mean revision indicators. Basically, mean revision move from an extreme to extreme, and they're trying to help us notice when the stock has moved too much and it should move to the other end. Some are more sensitive than others, but basically they have different calculation, but they're trying to do the same thing, which is to tell us when the stock moved too much to one direction and there is a higher probability of it to move to the other direction. If we take a simplified view of a mean revision indicator, it has a normal zone, and then it has like an oversold zone and an overbought zone. And the indicator will oscillate between these zones. The way that we trade it is if it's in the oversold zone, on the bottom zone, then it's bullish, and we say that it should go up. If it's in the overbought zone, then we say that it's bearish and it should go down. Other way to trade it is from the crossing. If it crosses from the overbought or oversold zone into the normal zone, then from oversold to normal, we say that it's bullish. From overbought to normal, we say that it's bearish. And also we can look at the breadth and how long the indicator was in the oversold or overbought zone, and kind of like understand that if it stayed unusual amount of time in that zone, it is a bearish or bullish signal. So we talked a little bit about, general mean reversion indicators. For this presentation, I want to focus on the RSI indicator, relative strength index. Technically, it's a momentum indicator, but because it has an overextended zones, we can use it for mean revision. I want to use it because it's common and it's very easy to use. Basically, the indicator moves between 0 and 100, where below 30, it's considered oversold and bullish. And when it's above 70, it's considered overbought and bearish. But whatever we talk about this indicator is applicable to other indicators, so we can easily use this for other indicators. But for this presentation, let's talk about RSI because it's easy and very common, every trading platform and a lot of information platform. You can find information about it very easily online. So before we start, let's look a little bit on some examples. These are recent price actions of various stocks. For example, Amazon. We can see that Amazon was in an oversold zone. It moved from about 150 to 135. This is a pre-split, so we need to double it, multiply it by 20 to get to the price before. But we can see that the price stopped here and moved up. Similarly, it was in an oversold zone. We can see a very strong move down. The RSI tells us that this is a very extreme move and the stock is oversold. And we did see a bounce before it continued. And then we have multiple support and it moved up again. Wells Fargo, it's another example. We can see that we have a very strong move up and the indicator told us that the stock is in an overbought situation. And we do see that it reverted to the mean a little bit before continuing up. And similarly, we had a very strong move down. The indicator told us that it's an oversold and it did move up again. Again, for Western Digital, WDC, we see a very strong move down and the indicator tells us that this is an oversold situation. The stock bounces up before it continues its trend. Similarly, we have a very strong up move. Again, RSI tells us that it's overbought and then it moves down. On Friday, the stock moved to oversold again. So it might be an interesting stock to follow this week and see how it performs. And we can practice what we learn in this presentation on this stock this week. So we saw some specific anecdotes about this indicator, but I now want to present a backtest that we ran in order to see the behavior on an aggregated level, okay? In this backtest, we ran from January 2016 until Friday. We ran it over the weekend to make sure that we have the most updated data. And this table specifically is for the Qs, the NASDAQ ETF. And the way that you read it is on the left, you see the event. And then the columns are different dates, 1 week after the event, 2 weeks after the event, 3 weeks after the event, and 4 weeks after the event. The reason that we test several time periods is because we want to focus on the entry signal, and we don't want to talk about the exit signal at this moment. So the way that we read this table is when the RSI was above 80, a week later, the Qs dropped 1% more than normal, to 1.8%. 2 weeks later, 1.71%. 3 weeks later, and 1.64% more than normal 1 month later. Similarly, when the Qs were under 30, it risen 3.35% more than normal. The normal is in quotes because it's average. Basically, what we did in order to isolate the effect of the RSI, we subtracted the normal weekly move of the Qs from what happened when the Qs was under 30 or above 70 or 80. So what we can see here is a mean reverting behavior. We can see that if the RSI is low, below 30, then we can see that a week later, 2 weeks later, even 1 month later, the Qs are usually bullish. They are performing better than average. And if the RSI is high, above 70 or above 80, these are overbought zones, we can see that the Qs are behaving more bearishly, right? So a week later, it's -1%, 2 weeks later is 1.83%, and so on and so forth. So it shows us that the Qs are mean reverting. Similarly, we can see on the SPY, we tested also that, and we can see that the SPY behaves mean reverting, at least in the short term. So if the SPY had a very strong move down, we can see that it will move up for the next week, but it is a bearish signal for the longer term. But when the SPY moved up strong and reached the overbought zone, we can see that it behaved bearishly afterwards. So it moved down. Again, we are subtracting the normal behavior of the index in order to kind of like isolate what happened with the RSI indicator. We also see this behavior in stocks, for example, Amazon. So we can see that under 30, it's bullish, and above 70, it's bearish. And also on Western Digital, that we're going to see an example soon, we can see that Western Digital moved very positive and very strong up after it was in an oversold zone. And it's even more pronounced if there was like a euphoria and a lot of people bought Western Digital and it went to the overbought zone, we can see that the behavior afterwards was very bearish. Again, this is a backtest for 6.5 years, from 2016 till recently, this Friday. So we talked a little bit about the RSI and then gave some specific examples, and we showed the backtest. But I want to focus on a specific trade that happened in February this year on WDC, on Western Digital, in order to show the nitty-gritty details of the trade and not just the textbook, you know, if RSI is under 30, buy, if RSI is above 80, sell. I want to show like the nitty-gritty and the details of the trade. So what we see here is that Western Digital dropped from about 66 to 54 in about a week and a half. And the RSI went to oversold condition. But then it gapped down even more, about 7% down, and the RSI became even more oversold. And then we see a strong move up, and the RSI moved from oversold situation. So we can see that the RSI was oversold on 2 days. So in order to test it, we will buy in 2 days. We'll buy one before the gap and one after the gap. And I want to show you how it works and what the behavior is, and that's why we have two trades. Again, we'll focus on entry. So we'll just have two exits 5 days later and 10 days later. We're not gonna try to time the exits. We're gonna focus on the overextension part. So here, trade 1 is before the gap down, and trade 2 is after the gap down. The gap was because of earning release between those two trades, but it doesn't matter. Let's focus on the RSI because I want to show the behavior. So basically, we bought 100 shares. The invested amount was $5,384. That's because the price was $53.84. After 5 days, the value of 100 shares was $5,229, which means we lost $155 or almost 3%. After 10 days, we see the price almost recovered to the same area, and we would have earned $25. Similarly, on trade 2, which is after the gap down, we managed to buy 100 shares for less than $5,000, so less than $50 per share. And after 5 days, the price was $5,181, which means that we profited almost 4%. And after 10 days, almost 8%. Basically, this is the situation if we have bought here, trade 1, and we bought again, trade 2, and sold 5 days later and 10 days later. So what we want to focus here is that, not surprisingly, if the panic, the more overextended the RSI, the more panic there is in the market, the better it is to take the chance and go long. This is the situation with mean reverting indicator. Also, although the loss was less than 3%, which is not a bad situation for this trade, know that it was lower. We did lose minus 7.5% if we look at the worst close, which means that when we trade it, we might want to trade it with a stop loss or something like that. So we need to take this into consideration. But now that we saw this trade with stock, I want to see how we can improve on it with options. So if we take a step back, there are two ways we can trade this with option. We can either pick a debit strategy where we buy the options and we pay the premium, and then we have the right for 100 shares, or we can sell options and then we have an obligation for 100 shares. This table is for oversold. So we're talking about buying calls or selling puts because these are bullish strategies. But if we have an overbought, meaning we're trying to do a bear strategies, then we can just reverse it, and debit strategies will be buy puts and credit strategy will be sell calls. Again, so let's look into how we can improve those trades. So if we're looking at debit strategies, we're looking into buying calls or buying call spreads. The difference is that call spreads reduce the risk, but also reduces the potential profit. And it depends on our portfolio size and how sure we are of this trade. The pro of a debit strategy is that we have a good risk reward profile. We only risk the premium that we pay, but we have unlimited profit. Or if we are doing spreads, then we can have that the potential profit is greater than the potential loss. Also, kind of like the stop loss is baked in the position because the premium that we pay is only a fraction of the cost of 100 shares. The cons of debit strategies is that time is against us. Every day that passes, our option is worth less. This means that we want to be right in the direction, but also quickly, right? We want to be right now. Also, if implied volatility is higher than the realized move, we will still not profit. This is a way of saying that if the market is expecting a strong move, then being right only on the direction is not enough. We want the market to move more. We want the asset to move more than the market anticipated. Okay, and this is easier to do when implied volatility is lower, but it is still possible. So we just need to take into consideration the implied volatility of the option. For credit strategies, which is sell puts or sell put spreads, we get even higher probability of profit because when an indicator is oversold, it has a higher probability of increasing, and selling out the money options have a higher probability of profit. So if we take these two benefits together, we get an even higher probability of profit. Also, time is on our side. So if the stock is moving in the same, is range bound, we probably will be able to close the trade for profit. The cons of selling option is that if we are wrong, the loss is much greater than the profits. This is because we are risking, we take obligation for 100 shares. So we're risking almost the amount we would risk for buying 100 shares, but our profit is capped with the premium that we collect. So with that kind of like understanding how we can improve, I want to go back to the table that we just saw, and we will add option trades. So basically, we add 4 trades for each trades. Let's focus on the calls first. So we picked a call for 5 days exit for trade 1 and for 10 days exit for trade 1. And similarly, for trade 2, we picked 2 options, one for the 5 days exit and one for the 10 days exit. The reason that we picked 2 options for each trade is because we needed to pick different expirations. So these will be different options. So for example, for the 1 week expiration, we picked call 55, which is just out the money for trade 1, and for 10 days we picked 53. We just picked something that is close to 50 delta. And for trade 2, we picked call 50 in both cases. So the first thing I want us to note is the leverage effect options have. Instead of losing less than 3%, we're losing almost all the money that we put because we were wrong on direction. So 3% loss turns into 99% loss, but also 4% profits turns into like 47% profit. Again, we need to notice the dollar amount is still less because the amount of money that we invested is less, but we have a leverage effect. Another point that we want to emphasize is how much money it cost us in order to get into the position. So in trade 1, it was before earnings. So the option premium were high, but still we paid $224 to buy the call 55. So this is less than 5% what it would cost us to buy 100 shares. And after earnings, we would have paid $137 for a weekly option, and that's less than 3% what it would have cost us to enter the stock position. So basically, buying these options give us kind of like a baked-in stop loss, right? We can't lose more than 3% we can't lose more than what we've put, which represent 3% of 100 shares. Also, I want to note the effect of the implied volatility of the option, and notice that the stock trade before earnings did profit if we waited 10 days. It's a small profit, but it did profit. However, when we took the option trade, and we chose the 53 option because it's in the money. Okay, the stock was 54.09 at that day, so it's $1 in the money. But although it's in the money, we're still losing money. Why is it? That's because the market anticipated a much higher move than what was really happening. So even though we were right in the direction and right in the time, we still lost money, and this is because of implied volatility. So it's something that we need to take into account and remember when we're trading options. Now I want to look at the selling puts. Again, we picked a different put for each expiration. But here we just picked the 50 strike put for all options. So for trade one and trade two, it's the same option. And for the 10 days, and it's the same option, but 1 day apart. So one thing I want to show, it's again the effect of implied volatility. If we had sold the put before earnings, we would have collected $134.50 to sell the 50 put before earnings. 1 day later, if we sold it after the stock dropped 7.5%, we would still be able to sell it and get $133. This means that if we had taken this trade and closed it, we would have closed it for $1.50 before commissions. Probably it would be a wash. So even though we sold this option and we're wrong in the direction, the implied volatility gave us some sort of a buffer and some sort of a protection that we still would be able to close it for a wash and not really lose. Another thing that we want to emphasize is the higher probability of profit that put trades have. We can see that the stock trade lost money and buying a call would have lost money, but because the stock didn't drop to the 50 strike, only to the 52 price, then we would have collected all the premium and we would have ended up with profit. Another point to note is the risk that we're taking, the amount of investment amount. To buy 100 shares, we would have paid $5,384, but to sell one put, then strike 50, then the risk is $5,000, which is $50 times 100 shares. So the risk is just a little bit less than buying the shares, but our profit is capped. So we need to take this into consideration when we are choosing how to trade options and what options to trade for this. I want to summarize the table and kind of like give you some tips and kind of like bullet points to help you remember this. So buying options will give us leverage and a built-in stop loss compared to holding the stock. Selling options will increase the probability of the trade ending with a profit. And the strategy you choose needs to be according to your risk tolerance and your conviction in trade. When implied volatility is high, selling options is usually better. This is because it gives you some buffer if you're wrong, and also buying options will be harder you'll be harder to profit with buying options. When IV is low, buying option is better because you have the unlimited profit and you have the limited risk. Also, if you expect volatility to remain high or to be high, it also makes sense to buy options. Patience, we need to wait for extreme conditions. The indicators help us understand when a stock moves too much to one direction, but it doesn't guarantee that it will turn to the other direction right after we took the trade. So we need to kind of like have patience, track this a little bit, and gain some experience on how this indicator behaves. The best thing that the best tip I can give you is try to paper trade this a little bit, even with pen and paper, and kind of like track several overextended stocks, and you'll be able to kind of like see the behavior and improve the next trades you take. You can use, by the way, Option Samurai for this. We have the scanner and you can find all overextended stocks with few clicks. And then we have a trade log so we can track it for you. Okay, so I want to wrap up the presentation and go into Option Samurai platform to show you how you can use the platform to take advantage of what we just talked about. So just to wrap up, stocks don't move in a straight line. They mean revert, meaning they move in a zigzag, right? The mean revision indicators help us identify the turning point. They help us when the stock gets to an oversold or overbought situation, there's a higher probability of the stock to move to the other direction. Backtests show that indexes and most stocks are mean reverting, at least for the short term. We measured mean revision here, and I'll show you also in Option Samurai, using the RSI with 14 days, but the concept will work for different amount of days in the RSI, like 5 or 21, or different indicators like stochastic or Bollinger Band or stuff like that. You should use option to reduce risk of your trade, debit strategies, or to further increase the probability of your profit with selling OTM options, depends on the outlook you have on the stock. And experience will help here. So use the scanner to just paper trade a little bit, find trades, see how they behave. Recently, when the market went into bearish territory, the overextended behavior changed a little bit from what it was in 2021. So tracking this and seeing how it unfolds helps you to trade this better over time. And with that, I'm going to finish the presentation, and I'm going to open, one second, the Option Samurai platform. Okay, so this is the Option Samurai platform. When you get in, you see your saved scans. I have a lot of scans. When you sign up, you only have whatever you saved. If you need any help, I'll be happy to help you with this. The predefined scans are scans that we've built to give you some trade ideas and help you get started quickly. The scenario engine allows you to focus on a specific stock and compare the different option trades for that stock. I'll show it in a second. And the trades is actually the trade log. I'll show it soon. I'm going to create a scan from scratch so you can see how it works. But on a side note, if you go to predefined scans and you click the naked put tag, the second scan is sell out the money puts with high probability of profit on stocks that are oversold. So this could be used to quick start what we just talked about, because this scan uses the RSI to find oversold stocks. And if you click the customize this scan, you will see the parameters we used, and you'll be able to change them and duplicate and save it for yourself. So this will help you get quick started on your own scan. But I will start from zero and show you how I do it. So I'll click the compose new scan, and I will pick the long call strategy because we already have a naked put scan. And the first thing I would do, I would add the RSI indicator. I search for RSI, and here it is. And now I will click on it to change the parameters. I strongly suggest that you read the help article. It's a very advanced indicator that you can customize for your own use. But again, here I'm going to use the 14 days, and I want oversold. So I'm looking for under 30. But here I want to do that it's inside oversold. And let's see if we have any that are 2 days inside the oversold range. Okay, so we do have stocks that are already at least 2 days in oversold zone in the under 30. The RSI is under 30, so this is good. I want to focus on stocks. So I would look for stocks, and sorry, this one. And I would just ask to see only stocks. I don't want to see indexes at this moment. So now I use my stock filters, and I filtered according to the stocks that I want. But now I will change a little bit the options filter in order to make them a little bit more loose, and also to make them fit what I'm looking for right now. So because I want a short-term trade, I will do expiration for next week, so between 26th and July 2nd. I would also want moneyness to be between -5 and 5, and then I would run. So basically, all options that fit the criteria are aggregated in one line. And if I press the plus, then I will see all the options, but I will get the best option that fit the criteria to represent that row. And the first thing I'll do, I will sort according to RSI, and let's see the minimum RSI. So now we see the stocks that have the lowest RSI. They are the most oversold. If I click on the row and go to the stock tab, I can see the recent price action, and the dashed line is the break-even point of the option. So this will allow me to go very quickly and see what different trades I can find. And this saves me a lot of time when I'm looking at oversold stocks and looking for a position. But what I want to do is I want to do something even better. I'm going to add a scenario, and a scenario gives us some sort of what it would be the options profit and loss in a specific scenario. So I can say, if the stock moves up 3%, I want to see only options that are profitable, for example. Okay, and now I've added another column. I can, by the way, add more scenarios if I want, but now I have this only options that are stocks that are oversold, and options that give me profit if the stock would rise 3% until expiration. I can also sort by maximum profit here, and I would see what options I have to, what different trades. Again, I'll click on the row and I see the recent price action. The blue line now is the scenario, and the dashed line is, again, the break-even point. But 3% is kind of like comparing apple to oranges, because the volatility of each stock is different, right? The volatility of Procter & Gamble is different than the volatility of Tesla, for example. So I won't do a 3% move. I will do a 1 ATR move. So ATR is the average true range, is a technical indicator, and it basically tells us what is the average daily move of a stock. So now it's comparing apples to apples, because the stocks that have a higher volatility, their ATR would be higher. So I ask for more. The scenario will check a higher move. And if a stock has lower volatility, then it will require a lower move. So again, I have now 1 ATR move up. And you can see that target, for example, if the option would move up 1 ATR, we can expect 100% profit. So we will make whatever we risk here. What I like seeing when I move the cursor, I want to see that the scenario and the break-even point are very close to recent price action. This means that there is no big resistance the stock needs to pass in order to show me profit. This increased, at least for me, the probability of profit for this trade. So I can just go one at a time and find trades that I like. For example, let's say Target. So what I do, if I see a trade that I like, I can click trade or this icon, and this icon will open me the trade window in a new tab. So this is the trade tab. And here I can customize the trade, right? I can say that I will buy it for $3 and I will buy the 145 strike, not the 144 that it suggested. And I will buy 2, not 1, 2.5. So what I do here is I can send it to TradeLog and paper trade, or I can send it to Thinkorswim or Tradier. So I'll send it to the TradeLog and it will add it to the trades tab. And now I can track it and see the trade and just follow it with time here. So here's the trade added 7 seconds ago. That's a Target long call. And if I want, I'll just save this scan. Let's call it webinar. And I will save this scan. And now under my saved scans, I will have this webinar scan, and I can just click it and I'll get the most recent results, even when time progresses. So next week, every day, I'll be able to see it. If I click refresh, I would see the new results. And I can also click on the watch icon, and then I will get email every time that a new ticker appears in this scan. So it will take a snapshot of the scan right now, and then it will run every time. And when it sees a different ticker that was not there before, it will send us an email and will alert me that I have a new trade that I can check. So basically, that's what I wanted to show you with the scan. I strongly suggest that you build a scan for overextended stocks. It can be oversold or overbought, and then track it and trade it with paper for a little while to get a sense of the stock behavior and how it works. And then you'll be able to trade it better. Another tool I want to show you is the scenario engine. Because we talked about Western Digital in the presentation, let's see Western Digital. So in the scenario engine, instead of checking all stocks that have oversold, we will check all possible trades for a specific stocks. So again, we'll pick Western Digital, we'll pick the same expiration, July 1st, and we'll say that we want to see what happens if Western Digital moves 1 ATR above. Once we click run, we will get all different trades, and we'll be able to compare it to buying a stock, right? So buying stock, we'll just see 1 ATR, we'll be able to see what is the profit. And then we are comparing it to long call, covered call, naked put, bull put spread, bull call spread, bull put spread, married put, which is buying call and buying put for protection, and a collar. So basically, the blue line on each of them is 1 ATR from current price. This is the scenario. And the dashed line is the break-even point. So here we're very quickly able to compare different trades. So for example, buying long call will risk $181.50, but call spread will risk $126. We can also see that the break-even point for the bull call spread is below the current price of the stock, meaning that if Western Digital stays the same place by expiration, we will still be profit, which means that the probability of profit is much higher for the bull call spread versus the long call. But the profit expectation for long call is higher because it is uncapped. To calculate, by the way, the expected profit and loss, we're using a Monte Carlo analysis here. We'll talk about it in a different presentation. We have a slider here that allows us to change our risk tolerance and according to how sure we are of the trade. So if we are really sure of the trade, we can move the slider all the way to the max return, and then it would look for the trades that will give us the most bang for our buck, right? The most return. On the other hand, if we go for max probability of profit, we will get the maximum probability that this trade will finish in a profit. And this is basically what I wanted to show you on Option Samurai. Just, your next step, start a free Samurai account. If you hadn't in the past, just send me an email and I'll extend your trial. So just go to optionsamurai.com, sign up for a free account and give us a try, check all overextended, paper trade it, and use it before committing real cash. Check the research tab in our blog. We have back tests like this one and other edges that we had and we checked, and you can email me and get the material for this presentation. My email is on screen. So with that, I finished. We have a few minutes, I think, for questions. So thank you very much for listening. And let's see if there's any questions. If not, then I'm done, and feel free to email me or use the chat in app and I'll help you from there. I think I'm done. Am I?
Okay. Yeah. Anyone have any questions for Leav? Okay. Do you see the chat, Leav?
Yeah, now I do see the chat. Okay, thank you very much, everyone, for joining. And yeah, I see this. Let me try and send me an email about this. Yep.
Okay.
Okay, perfect.
All right. Great presentation. Thank you.
Thank you very much for everyone. Thank you, David and Anka. It was a pleasure.